In today's video, we are going to go over one of the more common mistakes that I've seen over the years. It's something that at the beginning of your career, you need to fix or you'll be eliminated from the market. So stick around. Hi, I'm Steven Spencer. I'm a partner at S&B Capital. We're a proprietary trading firm here in New York City where we trade stocks, futures, and options. In order to be consistently profitable as a short-term trader, you need to identify good risk-reward entry points. At times, you may see momentum in price and think, I'll just jump onto that momentum. The problem is often when momentum seems to be the greatest and you are most confident, a move has almost run its course. And it's rare for a trader who is consistently entering at tops and bottoms to overcome both the low probability and low risk reward of these types of trades. We teach our traders to identify catalysts and then follow price action. We teach them to develop detailed trading strategies. When combining these two things, trainees can become consistently profitable. We see problems when traders develop a thesis and then become so married to that thesis and bias that they forget the context of the stock they are trading. Let's take a look at an example. What we're looking at now is a multi-day chart in Netflix, 30-minute view. And I've highlighted a few points where a trader from our desk was entering into trades. And I want to talk a little bit about whether or not there were good risk rewards, was this trader chasing momentum, and how this is going to impact their ability to be consistently profitable. So we're looking at the last week and a half, and Tesla was a weak stock starting early last week. It had started to sell off when it got almost to $700. And once it had that downward momentum, it made sense to look for good entry points from an intraday swing basis to enter into short positions. And what I've labeled on the chart entry point 1 is an entry point that the trader took, was a really nice entry point, was below $670 a share, and that led to lower prices. And in fact, that day it closed down closer to $630 a share. What happened was, because this trader was looking for Tesla to move lower, had a short bias, had a short thesis, they started to chase when it got closer to $600. And we know that, in a stock like Tesla, when it starts to get extended in a short period of time, it tends to have sharp reversals. And in this particular case, what we can see right in the middle of the chart, I've identified entry points number 2 and 3, and these were quite dangerous entry points. And so what you can see is it sold off really hard, entry point 1 that day, from the high 600s all the way down to around $630 a share. The next morning, it opened around 610, so it was oversold short term, and in fact we were looking for a bounce that day because it was so close to 600, and it bounced on the open to around $630 a share, and when it started to roll over again below 620, the trader tried to enter a short trade. And what you can see is on this chart here, I drew a downtrend line, and when something's been weak like Tesla was for the prior couple of days and it's moved lower, what I want to see is a significant bounce up to that downtrend that's forming before I even think about shorting it. And in fact, since it's come down from almost $700 a share a few days earlier, closer to 600, my mindset is I'm looking for it to more move sideways and then start to turn back up to play a bounce, maybe back up to 630, and if it starts to hold above 630, maybe 640, 650, etc. And so it's very important to understand that a stock like this that can be volatile doesn't mean anytime you're seeing weakness intraday, you want to chase it on the downside. You want to expand your time horizon and look at what is the context over the last 2 or 3 days. That's how we're going to think about making intraday trades. And again, in Tesla, we're not really looking for short intraday scalp momentum trades unless there's a fresh piece of news like the earnings report or some sort of problem with a factory or some good news or something on production numbers, or et cetera. When there's no major news coming out, we really are thinking, in the context of the last few days, what is a good entry point? Has it run up a lot recently? Oh, it's run up from $600 to $700. Is it having trouble here? Maybe I can buy some puts when it gets below $690, or maybe I can get short against $700 or $705 or something like that. But once it's then moved down, then we're starting to shift our view, cover my short position, get out of my puts, start to look at spots to get long, etc. Entry point number 3 in the middle of the chart is the stock that morning started above 630 and then it was dropped down to 620 to 610. It gets almost to 600. Entry point 3, the trader's pounding the bid to get short. You can't do that. Again, the stock is just, the prior day it had bounced from below 610 in the pre-market all the way back up to 630. The next day, you can't short it when on the open it was actually 640 when it's dropped all the way $30 in the first couple of hours. You need to be thinking, okay, it's come back into 600. Is it going to bounce again from this area? And in fact, you want to be doing the opposite. You can't be chasing the momentum at that point. So when we zoom out and think about the context, it's already extended to the downside. Entry point number 4. Now, some of you might look at this chart on the right side and say entry point number 4 was the beginning of it moving higher from below $600. It was bouncing into 630, 640, and then eventually today back up to 660. You might say, oh, why were they entering short there? This is when I even saw you on Twitter talking about if it got above 605, maybe it's going to bounce. I actually didn't have a problem with this entry because in the pre-market, the stock was being sold above 600 at 605, and right on the open, it flushed below $600 a share. So quite often, when you get that sort of weakness below a big number like the $100 whole number, and you get weakness, quite often it will bounce back up to the whole number, the 100 number, the 600 area there, and right when it comes into the pre-market resistance, you can put on a short trade, but understand, if it gets above 610 there, you just have to cover. So I actually didn't have a problem with this entry number 4. It was more so number 2 and 3 when it was already extended to the downside from those intraday, multi-day moves. And so this was potentially setting up for a new down leg below 600, but it actually held 590, got back above to the pre-market resistance, and then once it took that and started moving out higher, then the buyers were in control, and I was actually trading it on the long side. But it's understanding the context, not chasing momentum to the downside when something's already dropped $20, $30 or so. So the second example I want to look at was actually from the morning game plan sheet today, and it was Lululemon's earnings. And if you look at the game plan sheet, this is where we break down multiple support and resistance levels. I do this every morning in the pre-market. It's based on our proprietary stock selection process. I spend 30 minutes reviewing how to do that at tradingworkshop.com. So if you're interested in finding out why I chose Chewy, why I chose Lululemon, why we developed these levels, how to attack, go to tradingworkshop.com. 30 minutes on this process, as well as 3 low-risk, high-reward trading strategies that are commonly used by the top traders on our desk. So what you can see from the morning game plan sheet, in Lulu, I outlined 3 support levels, 300, 302, and 305, 3 resistance levels, 315.80 to 316, 318, and 320, and then an inflection point. An inflection point basically means right when the market opens, if a stock is above that level, I'm looking for it to move higher into the resistance. If it's below that level, I'm looking for it to move down into the support. And so in the case of Lululemon, it opened right below the inflection. And so my first thought is, what will it do when it drops into S1 or S2? And then to understand our theme for today, which is we don't want to chase, we want to look at context. And so take a look at the daily chart on Lululemon, and what you can see is at the beginning of March, when momentum stocks got hit, this got hit with the rest of them, had a pretty good bounce from the 270s all the way back up to above $300 a share. And then for the last 3 weeks, you can see I've outlined the consolidation area. The top of the consolidation area is around 318 to 320. The bottom of the consolidation area is around 300 to 302. And it's moving up and down in that range. And so when Lululemon reports earnings and it's gapping down this morning from around the I guess it closed yesterday maybe around 318, when it's gapping down into the 310, 312 area, I don't want to chase this on the short side. I know I have my inflection level. If it's below 310, I can short it, and look to cover into S1, see what it does at S1. If it moves below S1, get flat into S2, and then I'm starting to think about the long trade. And the reason I'm thinking about the long trade is you can see in the game plan notes, I wrote strong results, same-store sales up 21% year over year, and 94% online growth up year over year. These are very strong big picture numbers. And so in that case, if something drops from the inflection down to S2 especially, I'm looking for other momentum hedge funds, momentum traders to look to buy into that area. Let's take a look at the zoomed in intraday view. So what we have there is S1, S2, and S3. And if we look at where we're consolidated in the first 30 minutes or so, you can see buyers stepped in at S2 and sellers, once it was below S1, they were selling it at S1 before it eventually traded down to S3. And so what you don't want to do in this situation, what is not a good trade, is noticing that the first move is down. So you're like, okay, the first move is down. Maybe sellers will be in control today. When it gets to S2 and you see that initial pop back up to S1, and then the second time it comes to S2 again, and there's buyers there again, the third time what you'll see quite often is people start to short it and chase it and hit the bids there at 302. But at this point, you need to understand that you've already seen buyers step in there twice. The stock is already, when we look at bigger picture context, I've already showed you the daily consolidation area. And we know that since the big momentum blow off bottom at the beginning of March, this stock has been between 300 and 320. And so you have another reason not to hit the bids and not to chase and not to hit down here. And so when it finally does break below S2 there, $2 lower is S3, the bottom of the multi-week consolidation range, you should not be shorting there either. If you're going to be shorting this stock, it's gonna be when it bounces from S2 back up to S1, because that's a good risk reward. You know that until it starts to hold above S1, you're not looking for it to move back to inflection. So that's actually an okay entry. I tweeted this out. I traded it on the long side on S2 right on the open. I got a little bit more long into S3, and eventually when it got back above S1, it moves back up to inflection to 310. So from an intraday perspective, a lot can go on. You can trade it on both sides, but you have to have a detailed trading plan, and you need to understand not to chase it. And in fact, when it bounced back up to 310 and I got flat before we filmed this video, I'm not going to start then buying it at 309, 310, because I know that's where it sold off $10 from or $8 from right on the open. I'm going to see what happens when it gets to that price and pulls back. And it's understanding the bigger picture context and not chasing momentum on the upside in that case when buyers finally started to take control when it got back above 305. Today's lesson basically is, it's not enough to have a thesis. It's not enough to have a bias. You have to develop a detailed trading plan. You have to put in your support and resistance levels, and then judge intraday. Is it extended coming into this level? Multi-day. Is it extended coming into this level? And develop your plan and trade based on those things.